So diving right back into the numbers this week, we have the Bank of Japan interest rate. We're going to be talking about the inflation numbers that came out in the US, as well as the interest rate decision of the Federal Reserve. And we will also hopefully get to what's happening in the BRICS nations and kind of how that affects the US dollar. So with the Bank of Japan, they kept their interest rate from 0 to 0.1%. In looking at their meeting, they were talking, the heads of the Bank of Japan were talking about all the things that their economy is, slightly recovering, but still quite weak. We are going to continue to watch Japan to see what it does to the Japanese yen in terms of how their economy is recovering. When you look at what is happening in their inflation, you see that they have kind of a bit of a struggle with their inflation numbers. They want it at 2%, it's around 2%, 2.5%. So they're struggling there to potentially not let it go out of control, but also keep it within a healthy range. So the bank is not moving much. They've always been, they were the latest country to really move their interest rates up. They waited a long time while everyone else around the world was. So they're still kind of trying to figure out what they're going to do with their economy that is quite different than a lot of other economies, being an island, heavily connected to the US, but also holding a presence in Asia and trying to figure out how to navigate the global market. Looking at inflation in the United States, we saw inflation actually come down or remain flat. So inflation year over year went to 3.3%, coming down year over year from 3.4 in the month before. Core inflation actually dropped just a little bit more to 3.4% from 3.6%. So they're going in the right direction, but still high. It's interesting to see that the inflation rate is now the lowest that it's been since April of 2021. So we're now on 3 years of high level inflation. At the FOMC meeting, the participants were talking about their revisions of what they were expecting for the time moving forward, what they're looking at. They actually revised back or up actually how inflation will look in the years to come, and they don't expect to see inflation at their 2% mark until 2026. This is certainly concerning. I mean, beginning of this year, they were expecting 3, maybe 4 cuts to the interest rate. This year, now they're saying maybe 1 cut. So, they're still wrestling with this sticky inflation that's sitting in the economy, that's affecting the population of the United States, it's affecting the US dollar. But at the same time, unemployment is not, as we talked about last week, going out of control. It's at 4%. So they're still kind of in this weird position between inflation is not where we want it to be, so we have to remain strong, but also unemployment is not showing us an area that's too concerning that we really need to, I guess, change everything and start lowering rates so that we can get people more employed. Now, it is interesting to see that they also do expect inflation to rise for the next 2 years. So they are expecting for this inflation, for this unemployment to tick up as, the economy struggles, going into a hard time. Next week, we're going to be looking at the US consumer sentiment. So we'll kind of see what the people feel about this movement next week and give a better picture. So what we've kind of seen since the interest rate decision is that the US dollar has kind of stayed where it was. It didn't have any crazy movements in terms of the interest rate affecting its immediate movement of the strength of the US dollar against foreign currencies in general. We did see leading up to it losing some value kind of in the weeks before, but then right before, when everyone was expecting, hey, they're going to hold, they're going to stay, we saw that strength just tick up a bit, not a huge amount, but the US dollar kind of still held on to its relative strength, but again has actually dropped, a few percentage points from where its high was a few weeks and even a month ago. So there we kind of see this environment that really shows, okay, well, investors want the US dollar because they can earn a high interest rate on it. And inflation is slower than that interest rate. So I can actually still, make some money. I can get high yields. Actually, a lot of the BRICS nations wanting to do business with the BRICS, their central banks are actually hoarding a lot of US dollars, and they expect to continue to buy more US dollars and treasuries to get this kind of high yield asset, safe, high yield asset over time as the interest rate stays high. So that's quite interesting to see that some of these central banks are looking at the US dollar still as that reserve currency. At the same time, the BRICS nations this week released a trade deal that they are working on to get rid of the US dollar in terms of settling trade back and forth between certain countries. Countries like Thailand, Laos, Venezuela, Bolivia have, among others, have gone to this agreement with these BRICS nations to trade and settle their trade in their own local currencies as opposed to the US dollar. So we still see the secure prominence of the US dollar as a reserve currency, and at the same time we see countries really trying to figure out, okay, how can we do our economic business outside of the US dollar and the control that that has on us when we use that. So it's interesting to see how the US dollar will navigate through this all. Will it continue to hold its strength throughout the rest of the year, or will it continue, will it, I guess, follow its pattern of long-term devaluation? Again, from our side, what we see, we think the US dollar will not grow stronger. We think it will, over time, lose its value as it has been doing well past the 1960s. If we go back even 100 years, the US dollar has been losing value ever since. We think that trend will continue, especially with the inflation numbers that we're talking about, where it's always eating away at the purchasing power of the US dollar. And other financial jurisdictions and economies can handle their price stability differently with their own independent central banks. So that's something we're going to keep our eye on, what we're going to be talking about, what we look at, and to give you kind of a picture of what's happening around the globe. Next week, you can join us. We're going to be talking, as I mentioned, the consumer sentiment in the US, as well as the economic sentiment in Germany. So I'm looking forward to speaking with you guys next week.